Hello, class. Welcome to this chapter 8 lecture video. And in this chapter, we are going to be talking about liabilities. And more specifically, current liabilities and contingent liabilities. Let me go ahead and get my slide presentation going here. You're going to need the chapter 8 outline. That's what we're going to go through. Okay, so if you have that handy, I'll share my screen here. As I said, we're going to be talking about current and contingent liabilities. Okay. So liabilities, we can break down the current and contingent liabilities. So just some quick definitions here. A current liability is something that we expect to pay throughout the years, throughout 1 year. Okay, within 1 year. Don't worry about the size for a minute. Okay. Whereas a contingent liability is something that may or may not happen. So those are our two things we're really looking at. So current liabilities we're going to pay within a year. And contingent liabilities, things we may or may not pay depending on what happens. And when we talk about pay, it could be in the form of cash, could be in the form of services. It's just something we know. Liabilities are probable future sacrifices of economic benefits. So we could give out work, we could give out stock, bunch of things, okay? And they're always reported at the recorded and reported at the total amount owed. Okay, so we can pay cash. We have to know that it's certain that we're going to pay a liability before we record it. And also liabilities have to be able to be legally enforced, and we will get a payment receipt when they're paid. Okay, current liabilities due within 1 year operating cycle. Your most common current liability is going to be accounts payable. Okay, when you buy something from a supplier, buy inventory, buy supplies, you're gonna have a lot of accounts payable wherever you buy stuff from. And each company is gonna have its own account payable account. Okay, a subsidiary account. Okay, they usually do 30, 60, 90 days. They'll let you go. They very rarely require interest. Maybe they might charge you a fee if you pay late. There's no formal agreement, but sometimes there's contract terms where, just like when we're making sales, if we look on the other end, if we're making buying from suppliers, we might get that 2% discounted paid within 10 days or whatever. Okay. Another type of current liabilities are called accrued liabilities. And that's what we did back in chapter 3 when we did adjusting entries. Okay, we did that like salaries. So we had to recognize the salary expense. So we needed to do a salary payable. That's an accrued liability. Or we need to recognize some interest expense for a reporting period in order to get that expense in the right category. The associated payable with it is an accrued liability. Notes payable can also be a current liability if they come within due within a year. Difference between an accounts payable and a notes payable is just the formality of it. Okay, notes payable set exactly when it has to be paid back. Okay, they're usually longer than accounts payable, 3 and 12 months. Okay, so you get those 120 days, 180 days, stuff like that, 6 months. And a lot of times they have interest incorporated into it, where when you pay the note payable back, you're gonna have to pay some kind of interest component too. Okay, so here is an example where we borrowed $100,000 from a bank on October 1st at 10% interest. Interest and principal are due on October 10th, 2004. So we borrowed it for exactly a year at 10%. The journal entry on October 1st, well, we received cash because we borrowed money. So we're going to debit that, and we will credit a notes payable, which is a liability. Okay, interest expense will be paid whenever we pay the note back. But on December 31st, when we close the books, we have to record the amount of interest that has been earned up to this point and the corresponding accrued liability with it, the interest payable. You remember how to calculate interest payments? It is the principal times the percent multiplied by the period. So how much of a year have we used? So at October 1st, we've used October, November, December. We've used 3 months. Okay, so I'll go back here so we can see what we had here. So we take the $100,000 times 10%, times 3/12. Okay, and that's how you get this $2,500 down here that is owed. Okay, that's the amount we're gonna expense for this year, the rest of next year. Okay, so now when we go to pay the note back, we can take the note payable off the book because we no longer have to pay it. We can take our interest payable off the book. Okay, now we need to record the rest of this interest expense, which would be the 100,000 times 10% times 9/12. Because that interest expense was incurred this year for the note, and then the cash is the total paid out of 110,000. So there's your simple recording for a notes payable. Another part of current liabilities is the current portion of long-term debt. The long-term debt we're going to get into in chapter 9. That's basically a long-term notes payable. It's due 5 to 10 years, or long-term public borrowing through bonds. Okay, but at the end of each accounting period, whatever is due within the next years, it might be a 20-year bond. But if we're paying it off next year, it has to be moved into the current liability section on our balance sheet whenever we make those statements. And then we have some other payables. Okay, one of the big ones is sales tax, sales usage and excise tax. A company collects them, but it is not part of the company's revenue. Okay, so when we record a sale, if we sold, well, here we got an example, during the first quarter, McLean County Tire sold on credit all these truck tires at 180 each, plus sales tax of 7% and municipal taxes of 1%. Okay, so that goes on to the sales price. The customer's paying that in addition. Your revenue here is only going to be 180 tires, $180 per tire multiplied by 1,250 tires. That is our sales revenue. Then we create two liabilities here, two sales tax payables, one to the state, one to the city. So you take the tires price, the revenue, multiplied by the percent, 7% for the state, 1% for the city, add them on, and then we're going to send out a bill to our customers for $243,000. Okay. And then once we collect from the customer, then we will turn around and pay the sales tax to the state and the city for that customer. Okay, so we receive the cash when they paid off this receivable up here. And then we turn around and pay off the corresponding liabilities. And the last major payment, cash payment type thing that we have is withholding and payroll taxes. They are not the same. Okay, whoops. I did go backwards. Okay, so when we pay employees, employees have to pay federal, state, and sometimes local income taxes. Okay, that is not an expense to the business. We are just withholding it as an employer out of the employee's paycheck and then paying it to the proper jurisdiction. In the same way, Social Security and Medicare are withheld from an employee's pay and paid out to the federal government. And there's other things that could be coming out of the employee's paycheck, such as retirement, parking, union dues. Okay, everything we give to the employee gets expensed, even if they don't receive the cash for it, even if we withhold it, as you're going to see. That is withholding. Okay, payroll taxes is something completely different that a lot of people don't even know businesses have to pay until they get into this accounting class. Okay, an employer must match whatever the employee pays in Social Security and Medicare taxes. The employer must match that out of their own pocket. Okay, all of these payroll taxes, they are all additional expenses to the business. Okay, federal and state, they all have their unemployment taxes. The federal, it's called FUTA, F-U-T-A, federal unemployment tax, and SUTA, state unemployment tax. Okay, and then sometimes even employers will match some of the 401k or pay some of the health insurance. Okay, these are payroll taxes. They create an expense for the company. Okay, a separate expense in addition to the wage and salary expense. So let's kind of see how this works out. Okay, assume that McLean County's Tire hourly employees, they earn $48,500 in payroll. Then it tells you what federal income taxes were held. A state unemployment tax and a federal unemployment tax are required to be implied by employers. Okay, so they earned $48,500 in wages. Okay, so that becomes our wage expense. That is our debit. Whatever the employees earned, that's what we debit as wage expense. Okay, and then we have to start taking stuff out. It said they took out 10,185. Okay. So we would create a payable for federal income taxes. We withheld that from the employee. We're going to pay it later. Social Security and Medicare. Okay. As you can see down here in the bottom left, these are the going rates right now. Right now, the Social Security rate is 6.2% for employee and for employer. So whatever the employee makes, 6.2% of that is getting paid by two parties into Social Security, whereas Medicare, 1.45% is getting paid in by both parties, which works out to 12.4 and 2.9% of your income total is going into Social Security and Medicare. So you take your expense, multiplied it by the 6.2% for Social Security, the expense multiplied by 1.54% for Medicare. Okay, and those got to become payable out of the employee's check, employees, all of their checks. And then the cash, the amount of checks that are actually written are going to be 34,604.75. Okay. So that is just recording the paychecks that are actually going out. But here you can see we are also going to have all these other expenses incurred to the business. The federal unemployment tax percent, the state unemployment tax expense. That is the wages, the expense multiplied by those rates. And then, like I said, the employees have to match the Social Security and the Medicare tax by the employee. Okay. And we would credit the correct payables on those. Which of the following is paid by both the employee and the employer? Well, the unemployment taxes are employer only, the income tax is employee only, but the FICA, the Social Security and Medicare, are paid by both. And our last kind of current liability here is unearned revenue. Unearned revenue we talked about previously in our adjusting entries. This is when someone pays us cash. It creates a liability to us because now we owe some goods or some services. Okay, unearned revenue becomes revenue once we provide the goods or services. So gift cards, a good example of unearned revenue. So here we sold $100,000 worth of gift cards. When we sold them, we received cash for $10,000, but we still owe goods or services. In this case, gift cards is probably goods. They can come into our store and buy stuff of $10,000. During the year, as they came in and purchased $98,875, we moved that out of unearned sales revenue with a debit, and now we can credit our sales revenue at this time. Okay. And even though when they expire, even though we did not actually sell any goods, we saw the cash for it, we saw the count that as sales revenue, and we just kind of double dipping there, which is a nice little thing when people let gift cards expire. Okay, finally, contingent liability. Okay, contingent liabilities is where something could or could not happen. Okay, we are only going to put these into the financial statements if we conclude that the event is probable that we are going to have to pay this, and we can reasonably estimate the amount we're going to have to pay. Okay. These are how we're going to rate them. Okay. For a contingent liability, this could be like a lawsuit, a warranty, coupons that we sent out. So something you'll learn in intermediate accounting called an asset retirement obligation. Okay. These things, they could be probable. Okay. If it is probable that it's going to happen, we definitely have to make a journal entry. We record it, put it onto our financial statements. If we determine that it is only reasonably possible that we will pay this, okay, Here, we do not make a journal entry. Rather, we put it into the notes of the financial statements. So we'll put a little note at the bottom of our balance sheet saying, look here, we may have a future liability. It's reasonably possible that we may lose this lawsuit and owe $100 million. However, if it's probable we're going to lose, we'll put it in right away. Now, if it's remote, that is the third category, we can kind of just basically ignore that. Okay, we do not need to record it or put it into the notes. Okay, so those are your three ways to classify contingencies. Is it probable, reasonably possible, or remote? So know those and know how they are differently reported. Probably recorded, reasonably possible in the notes, remote is ignored. So here we have a company engaged in a lawsuit. They believe it is probable that Marina will lose the suit. It would be required to pay $2 million. How should they recognize this contingent liability? Here, a journal entry is required in the amount of the probable damages, okay? It's probable, that's the key word we were looking for there. Remember, it's probable, reasonably possible, or remote, but it's probable. And they say they're going to have to pay $2 million, so that is the estimation. Okay. This is what a disclosure would look like if you want to look through that slide. One of the major contingencies besides legal fees are warranties. Okay, warranties, you know, if you buy a car, buy some electronic expense, I always ask you if you want the warranty. Okay, warranties guarantee that if something goes wrong, they're going to replace it or fix it. So the fixing or the replacing, that is a cost to the business. Okay, but that darn matching principle comes back into play here, where we got to make sure that our expenses matches our revenues. So when we sell something that has a warranty, we're going to have to estimate it and create an expense in the same period that the sale is made. And but that expense also creates a liability, a warranty liability that we will slowly reduce as people bring back their defective products in order to have the work done that it needs to be done. So here's an example of that. We offer a 12-month warranty on our computers. That one computer of each 2,000 sold will require a warranty service. And the warranty claim will cost Nolan $155. So 1 out of 2,000 is going to cost them $155. Okay. So we have to record that expense at the same day we make the sale. So if we sold 3 million computers, we would have to estimate how much we think the warranty expense is going to be on these computers. So we have 3 million computers sold, multiplied by 1 over 2,000, because 1 of every 2,000 are going to fail. So 3 million divided by 2,000, and then multiplied by the cost that we assume 155, and you can see it equals 232,500. So that's what we record as a warranty expense to match with the sales, and we create the additional liability at that time when the warranty work is performed. So we reduce the liability. We no longer think that much is going to be out there. We actually did $18,700 worth of work. And how did we do it? It cost us $10,400 in cash, and it cost us another $8,300 in inventory. So you would credit here however much it came off. Okay, could have came out of your regular inventory, your merchandise inventory, if you're just replacing something there. All right, and that's where we're going to stop for this chapter. Those are the main things you need to know. Be sure to check in with chapter 8 handout video. It's got quite a few questions that I'm going to go through. That'll help you with your homework. Okay, we're getting near the end of the semester. Keep up the great work. You guys have been a wonderful class. I'll talk to you again soon.